Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. Let's take a look at the midweek market update, and it's all about ETH again. Everyone wants to know more and more about ETH outside of crypto, inside of crypto, what's going on, what's happening. So let's do a quick review of the similarities and differences, what makes Bitcoin unique. So Bitcoin has a max supply of 21 million coins. It has a programmatic reduction built in every 4 years. This is referred to as the halvening or the block reward halving. You can see here on the chart when those have occurred, how issuance has continued to decline, and currently inflation sitting at 1.7% thereabouts. In between these adjustments of issuance, you will see slight variations in inflation and issuance dependent on hash rate and difficulty of the network. But for the most part, until the next halving, the inflation rate is static loosely at around 1.8%. So that's Bitcoin. It is very specifically one thing. It does one thing. And the next halving, here's the halving clock, is in 566 days. We can project this day out. We can map this out based on hash rate and difficulty. Unlike Bitcoin, Ethereum's pretty much said, you know what, we're going to try to move fast, break things, be exciting, be different, which can be good, can be bad. There are trade-offs, just like any evolution of anything. And for a long time now, they've said we're going to switch from proof of work, which is miners and ASICs and GPUs, to proof of stake. And I believe this was in their original plans, and it just kept getting pushed back. And the reason you'd start with proof of work is because it's a really good distribution mechanism. It's a more fairer way, let's say, than issuing shares to a select group of people via something like an initial coin offering or an ICO, which they also did, but this helps distribute the coins over time. That's the idea anyway, right? Even in Bitcoin's case, this isn't perfect. We still have pockets of people who have a ton of BTC. I just saw an on-chain alert basically today for someone who was moving 10,000 BTC around. Those people still do exist, but in general, the distribution methods of proof of work are much better than we've seen so far. So ETH is deciding to switch to proof of stake, and how they're going to do this is by basically hot swapping from one to the other. They're going to jump from proof of work, that's going to stop. They're going to switch to proof of stake, kind of like switching out your engine while the car is still moving. Similar, risky, and dangerous, but they've tested this in testnets. They've tested this in shadow forks, which are kind of just like stress testing in different environments. They've had minimal issues. Really the biggest risk here for ETH, specifically the chain, is you switch out the engine and the car doesn't run anymore or it doesn't start, right? They had some issues with this where you'll see multiple chains sort of spark out of this, kind of like a multiverse, right? Eventually they all converge, but in these first few blocks, we will know very quickly, how much trouble the chain is in. It is unlikely to get in massive trouble, but it is decently likely to have some issues initially. I don't want to say there's a massive risk here because there isn't, but I would think that there may be some issues switching proof of work to proof of stake. We're talking the first couple blocks, right? When the network's trying to figure out where the leading chain is, basically. And at the end of the day, no one's probably going to even notice this happened, assuming all goes well, which it should. It's just we've never seen this transition at this scale. So obviously it's important to know when this is going to happen and plan accordingly, let's say, right? You don't want to have some massive leverage position open or a bunch of stuff open in DeFi where you can have some second order effects with oracles not reporting data correctly. Who knows? But it's important to just plan it out. If you plan on staying in the ecosystem, stay in the ecosystem. But there is a non-zero chance some shenanigans happen here on the chain. So you just have to be aware of that. But in general, shouldn't be that much of a big deal for any other person facing Ethereum. And another thing that has been brought to the forefront with the merge is the change in issuance. So again, unlike BTC where it's programmatic, it's specific, it's unchanging, with ETH, they've tweaked the issuance every now and then, adding things, subtracting things. And the way it's set up now, the reason why everyone's talking about it or looking into what's going on mainly is the issuance piece. So issuance technically does not go to zero, but that ETH is locked up and effectively vested until it's able to be removed from the validators. Additionally, the validators, 14 million ETH currently, are sitting also locked until that code is added to the chain where they can be liquid again. So there's all sorts of interesting liquidity trades, futures, options, second order stuff that's going on here with Ethereum for people trying to map out what's going to happen. And this isn't happening in 560 days, it's happening in the next month and the next 16 days. That's why everyone's really focused on this. So it's a consensus mechanism change that they've tested for a long time now with minimal issues. Any issues that they've run into, they've fixed or they've patched over. And realistically, there's probably extremely low risk for ETH, the chain, to undergo any massive problems switching over. Now, the interesting stuff comes after the merge. Currently, we have X number of ETH being staked, 14 million, and there are, X 100 million circulating supply. So the question is, how much of that ETH is going to actually end up being staked additionally? And do we get more liquid staking type of DeFi protocols? And we can sort of compare this to every other staking token, staking chain. There's Cardano, Solana, Binance chain, the list goes on. And if we focus on the staking ratio specifically, right now, the staking ratio for ETH, this is staked coins versus the rest of the market cap, sitting at around 10%, which just looking at this list is relatively low. And this makes sense that it's low because, again, your coins are locked for at least 6 to 12 months after the merge, if not longer, if they delay the code changes, or the code changes are delayed. I am a bit realistic, and they've delayed code before. I think they'll delay code again, so it may be past a year even when these coins are unlocked. In these other chains cases, for the most part, you can bond or unbond them within 2 weeks, let's say. This varies from chain to chain, but that is much different being locked in staking for an undetermined amount of time, considering price volatility and everything else that's going on. This 10% of supply, what I'm trying to say, these people are probably forever stakers. They're not going to unstake. They don't want to unstake. They know the risks. That's my assumption anyway. So the question here becomes, how much of this actually goes up after the merge is successful? And then after that, once staking rewards are unlocked, does staking go up again? So this is important to think about, because if more and more of the supply or the float gets locked up in staking, then that has this secondary effect, right, on price. If demand increases, supply decreases or stays the same, right? Just basic supply demand type of stuff. And this has worked well in the past for other chains, and other chains have adjusted this principle of quote unquote staking, where you're not just necessarily taking your stake and putting it somewhere. Past staking it, you can then unlock it through liquid staking and kind of double down on what it's used for. Another way I like to think about this is, if 85% of the chain is being staked, that tells me either there's really high liquid staking percentages, or there just isn't anything else to do with the chain, which is problematic. But for most of these chains, the average is probably 65% total. So you have to think that ETH, as a percentage, this increases significantly with successive checkpoints of the merge flipping over and then staking rewards being unlocked. And then you have to think about what that will do for price, what that will do for the staking rewards and issuance in general. Now, we already have one liquid staking derivative called staked ETH, and this was put forth by Lido, which is a staking service. And now the question becomes, this was rather successful from Lido's perspective. From the contagion perspective and what happened with Three Arrows Capital and Celsius, not so successful. But maybe that was because all of the liquidity was in one specific spot And if you look at your ability to actually withdraw this stuff, if you're sitting on a significant portion of this, it's very difficult to unwind your staked ETH or transfer from staked ETH to ETH based on this liquidity, based on this exchange rate. It's very difficult to swap between the two when you're losing a significant percentage each time you swap back to ETH, right? So if more services enable liquid staking derivatives, which is certainly possible, then that may change the script a little bit. If we're increasing liquidity, that may decrease concerns for events like this to happen or that have happened with staked ETH. Now, Coinbase has come out and said they're going to add an ERC20 token wrapped staked ETH, specifically Coinbase ETH. So then we're going to have all these these interesting trades between, Coinbase staked ETH and XYZ staked ETH. It's going to get very wild and interesting down the road because we're just introducing more kind of layers of complexity here. And then if you plug this into DeFi, which I'm sure is going to happen and has happened already with staked ETH, then things get even crazier because you're locking in that liquidity that has a risk of being liquidated. So all sorts of fun stuff down the road in that regard. Switching gears to on-chain activity across the board, and I'm going to go through a few coins here. On-chain activity, for the most part, is flat or down. The only chain this week that I saw activity actually perk up a little bit was Cosmos Atom, which I don't actually have up for the video, but Bitcoin, Ethereum, Binance Smart Chain, Polygon, Avalanche, activity's down week over week. For Bitcoin, it's not as dramatic or drastic. It's still within the range, right? Not a lot going on. In general, price rise. Obviously, we've had volatility, but we're still in the range that we have been in for the past several weeks now. If we look at ETH, this looks dramatic, but if you know that the active addresses and the transaction counts rose dramatically because of one specific player, mainly Binance, when they were shifting transactions around, consolidating wallets, probably in preparation for the merge. And this doesn't look as bad, but the activity is still down week over week, right? On average, it's certainly more flat than anything, but it's down week over week. Interestingly, though, Bitcoin and ETH are both continuously just being pulled off exchanges or put to work somewhere else. This is all the centralized exchanges. So this is Bitcoin and ETH. If we look just at Bitcoin, Bitcoin is now at multi-year lows as far as balances on exchanges. And again, if you think about what's available for sale versus what you can buy, that's where this narrative starts to percolate out. A lot of people joke around and they say, well, Bitcoin's only 10 minutes away from being on an exchange. And that may be true, but for a lot of people, just like those forever stakers on ETH, there are a ton of forever hodl people in the Bitcoin community. I count myself amongst them that don't have Bitcoin on exchanges. They just, keep it on a hardware wallet. And I think part of that narrative is certainly taking hold as people are stacking sats, as they say in a bear market. For ETH, it's interesting to see if we dial this all the way back to the ICO era, post-ICO era, and then DeFi. You can see how that has changed this profile for Ethereum on exchanges. Currently, we're seeing new lows actually for ETH on exchanges. Generally not a bearish outlook when you see that. If people are depositing tons and tons of coins to exchanges, typically that's much more bearish. Bitcoin's Lightning Network second layer also seeing an increase in capacity, which means people are sending BTC into the Lightning Network to be used and put to work in layer 2. So that also signals that this utility is agnostic of price, doesn't care where price is at. And it's interesting that it's acted as an inverse, if anything. As price has gone down, the number of BTC sitting in Lightning has gone up. And one last just housekeeping thing I like to keep track of is Tether versus USDC circulating supply. It looks as though they may have come to a standoff equilibrium here based on where they sit between 68 million in Tether's case, 52 million in Circle's case. And this also to me does signify this is money still in the pipes and in the ecosystem. This isn't money that's gone forever and left just because price is down. I think you could imagine a different picture where stablecoin circulating supply is very fluid with prices, and we've certainly not seen that. We've seen stablecoins still remaining in the ecosystem. One way we can check just generally where is the utility, who's using these chains, what's going on. We can look at fees on the chains or on the specific protocols themselves to see, is anybody using this stuff, right? And this will change in a bull market versus a bear market versus a neutral market. You can see the fees on ETH are significant. Binance Smart Chain, Bitcoin, and all these other protocols. Solana's in the mix, Polygon, Arbitrum, which is a layer 2 on Ethereum, and the list goes on and on and on. But you can see that even in a more bearish market, we do see activity here. And just flipping through, kind of zooming out and seeing how stark the on-chain activity has declined, right? The silver lining of all of this is it's going to be extremely obvious when activity picks up again, because it's been declining for so long, really for 8 months now. It's been declining for so long. It's generally pretty flat. Here's Polygon. These are all block explorers specific to these chains. This is Avalanche. This is just the C chain. So on top of this kind of utility fee question, we have this complexity added to all of these chains as they get more layer 2 type of initiatives. For Avalanche, it's subnets. And if we look on a different calculation, you can see transaction counts plus the subnets. It doesn't say that here, but this is with kind of the side chains or the layer 2s. Everything else in the Avalanche ecosystem, Avalanche has 3 separate main chains, and then an infinite number of subnets can be created. Users, though, still down over the past 8 months, certainly. And this gets even crazier when we look at something like Polkadot. Just looking at face value, Polkadot, the chain, if we look at new accounts and active accounts, it looks flat, it looks down, obviously, like everything else, right? We can kind of zoom in past year, generally fairly flat here. But then it gets interesting when we think, okay, there's all these side chains and layer 2s, and in Polkadot's case, it's got all of these other ecosystems built on top of it. And the question becomes, where does the value go if all of these have tokens, right? Does the value go to Polkadot? Does it go to all these individual tokens? Is there a way to marry the two in value? And I think that's going to be the next question. Is we've built these layer 1s, we're building out layer 2s and side chains. Do we see value accrual to the layer 1, or does it go to the layer 2, right? And that's dependent from chain to chain, but it's a conversation I think more and more chains are going to be having, because this is Moonbeam, this is a side chain or a EVM compatible parachain of Polkadot. So the question is really like, are these side chains and layer 2s parasites on the main chain, or do they actually bring value, to the main chain? Just an interesting thought experiment. And lastly, before the TA section, OpenSea as well, which is the leading NFT exchange on Ethereum, also seeing a decline in volume, users, general activity. So that is across the board as far as declining activity is concerned. Flipping gears to technicals, much like on-chain activity, price is also sort of sitting at lows or near lows or declining over the past couple of weeks. Really the main focus for me over the past few months has been these downward trend channels. You can draw this however you want, but this is specifically a pitchfork. And generally how these work is if we escape this downward trend, right? It's fairly obvious you're above the pitchfork, and that trend is nullified, negated, canceled. So far, we've seen evidence that that is not the case. We've seen evidence that we're continually sitting in this. So if we just measure this from a TA perspective, from wick to wick with Fibonacci extensions, there's a possibility that if we break lows currently at 17, 18,000, then 13,000 is the next level down. Alternatively, we could see plenty of support at this level based on the 2017 all-time high, based on the 200-week moving average, and make some mean reversion attempt back to 30K around the 200-day moving average. I think this is too close to call. Obviously, the general bias for many months has been bearish, but this is very much an if this, then that situation. If we break lows, then we tip bearish. Right here, I think we're sitting fairly neutral with the bearish expectation, but we need to kind of wait and see. Zooming way out, if we look at stuff like a logarithmic regression. This is power law corridor, but similar. Again, we see historically, this is loosely based on line of best fit based on the previous 3 all-time highs. So if it's trying to give you some forward signal as far as range low or expectation, that's in line with that 13K, 14K level. Looking at the 2-year MA and the 2-year MA multiplier, it's also telling you we are more in the oversold section than the overbought section historically. And these are the halving dates, these red highlights. So we definitely tend to do best price-wise coming out of a halving, coming out of this oversold section on the multiplier. And then ETH is a similar story, maybe not as bearish. It's still within its bearish trend channel. It still hasn't escaped that expectation yet. Its supports look slightly different considering it's above those supports. ETH's downside is also probably limited to around 1,000 based on previous lows, right? Massive psychological level as well. This was essentially a full mean reversion already to the 200-day moving average. Just tons and tons of volatility here with merge hype, with economic data globally coming out, signaling hawkishness from the ECB, hawkishness from the Fed and the US, energy crisis, geopolitical issues, right? We're seeing just tons of reasons for volatility, and we're certainly experiencing that on a day-to-day basis. Then lastly, the ETH BTC chart, which is where the focus is for a lot of people, because this looks particularly strong considering where it sits historically, considering upside resistance levels based on previous highs, previous wicks. It's never sat in this level for this period of time. So to me, this looks very bullish that it's sitting up here for over a year, almost 2 years now. It tested the 200-week moving average. This is after Celsius, 3 Arrows Capital, all the nonsense that went on there. This isn't particularly any chart pattern or, to my knowledge, anything that's signaling this needs to go higher, but it certainly has a narrative and eyeballs on its side. Let me know what you're seeing out there. If I'm missing some on-chain activity on your favorite chain, that's all I have. This one, like, dislike, comment, share, subscribe, and happy trading.